Thank you very much to the CLA for persevering through all the tough times that we all had and putting on a great conference agenda for today. So why don't we get started with a little bit of introductions. Maybe we can start to the far left. We're trying to keep the introductions pretty short, so just kind of name, title, and company, that would be great.
Neil Wexler, On Deck Canada.
I'm Jeff Mayer. I'm with SLC Management.
And Ed Goldstein, IAD Group.
Perfect. And my name is Karanjit Bugra. I'm from Echelon Capital Markets, and I also sit on the board of the CLA. So this panel is on raising in a downturn, and obviously we're in a very interesting time, unprecedented inflation, at least in the last 40 years, as well as a unprecedented interest rate environment. So we're going to try to address a lot of people's questions and concerns about how do you grow your business despite the economic times, and specifically from both an originator's perspective, and we have two funders as well to give their thoughts. I want to start off with you, Neil. You've had an extremely interesting year so far. You've completed MBO, management buyout of your business on the Canadian side. You've also recently increased your facility with BMO and Equitable Bank. Never heard of those organizations, but they're pretty good. So you've had an interesting year. How did you navigate all of that in this type of environment? If you can walk us through any of that process and some insights, that would be great.
Well, I started with a lot more hair than I have now, so. No, actually, we're grateful to BMO that's built out an amazing specialty finance franchise, and to Equitable for joining in this recent financing that we announced. It gives us capacity to execute on our profitable growth plan, and it's not something that happened overnight. I think that BMO becoming our senior lender about 5 years ago demonstrated a certain amount of confidence in our business model, and then over the years we kind of did what we said we were going to do. And as you establish that kind of credibility, they're willing to work with you. And I got to tell you that COVID obviously was very challenging, and you didn't know where it was going to end up, but the lines of communication were always open. And I think that we were also fortunate to be under-leveraged going into COVID. And we've always taken this approach that being over-capitalized and under-leveraged is a good thing in a credit business, as a private credit business in particular. It may not maximize your returns, but it gives you a sense of comfort when times are tough. So we've always taken that approach. This recent facility took more than 6 months to put into place. And I would argue that while our borrowing costs are going up, given the environment that we're in, we sleep better at night knowing that we have the support of the institutions like BMO and Equitable.
And just speaking specifically on the MBO, describe a little bit of the push-pull in that situation, particularly in the environment that you're in. Certainly, there might have been some days, is this the right time? Is this the right valuation? How did you go through that process?
So we did a transaction with On Deck in the U.S. For those of you that are familiar with On Deck in the U.S., they were really the leader in digital online lending for small business going back a number of years. And we did that transaction in 2019 for exactly kind of the same purposes that I talked about just now, in terms of being over-leveraged, under-leveraged and over-capitalized. They injected equity into our business, gave us that big brother type of support. And going into COVID, they were approached by a large consumer lender out of Chicago that ended up buying them. And they made it pretty clear, Innova, the purchaser, that they weren't really interested in Canada. So we had ongoing conversations, and we resisted the notion of selling On Deck Canada during COVID. And we resisted because it didn't really make much sense to us, as there was so much uncertainty. But Innova went down the road of selling Australia, selling ODX, which was this technology platform that On Deck had owned. And we resisted until we saw a light at the end of the tunnel of COVID, and until we could get a negotiated situation where it made sense for Innova and made sense to us. The nice thing is we still have a great relationship with Innova and the On Deck people in the US, so we're able to leverage their scale and knowledge base and the like. For us, we had the support of BMO, again, confidence in us, and the timing just seemed right to repatriate the business, and ultimately, this is about our team. You know, I would argue that we have a great team internally, and it's that team that gives us as shareholders the desire to own back the business, if you will, and to take it forward. And if you didn't have the confidence in the team, then it becomes that much more challenging to get over that hurdle as now the right time. But being what we've all been through during COVID, it just demonstrated that if you have the right people and they rise to the challenge, then you're well positioned for the future. And that's how we chose to do what we did.
That's great. If I'm hearing it correctly, you know, it sounds like the conservatism on the front end helped you navigate and see the path forward, and when you saw light at the end of the tunnel, that's when you seized the opportunity.
Exactly.
Let's switch over to the funders on the panel over here. How have you found this environment, particularly in supporting your portfolio companies, companies that you lend out to? Maybe if we could start off with Jeff at SLC.
Sure. I think so far this year, I think what we've given our portfolio of companies, and we probably deal with around 30 names that we fund, is kind of what Neil said, is just giving them that a stability of funding, knowing that we've been through the financial crisis, 2008, 2009. We funded through that, allowing them to do their business. They are the experts. You are the experts in your business. We are the funder. You know what? We also view ourselves as a sounding board as well to deal with, because we've been through a lot, and we have the benefit of seeing a number of companies. Of course, we don't violate any confidentiality or anything like that, but we think we can add a lot of value there too. So, and quite frankly, we even deal with a few businesses in the U.S., and if anyone follows the ABS market in the U.S., it's pretty choppy right now, and we even had a few names that couldn't get their total deals sold, and we picked up some of those lower end of the tranche scale. So it's been an interesting time, that's for sure.
And Ed, from your perspective?
Yeah, well, I think you hit on a lot of important points. I as you were talking, I was thinking about a comment an old boss made to me about pattern recognition in the investment business, and I always thought, you know, it was his way of being an ageist and telling the younger team that they weren't ready to advance in their careers. But the truth of the matter is, you know, you build a lot of muscle memory, you know, and kind of per the, you know, both panelists' comments, you know, these kinds of environments really pressure test your businesses, and I think you learn a lot about product market fit, the stability of your funding, you know. So on a kind of more pragmatic basis, I mean, we try to be a steady hand. Similarly, you know, Sage Counsel, we see a lot of things. So where we can be constructive, we want to be, you know, we don't want to be just another voice in the room for the sake of it. You know, most of our, if not all of our businesses have institutional venture funding or equity funding. So there's plenty of voices in the proverbial ear. I will say, you know, one of the things that distinguishes us in the market, you know, as a private fund, is obviously, you know, we're not investing off of a balance sheet per se. We have committed capital. It's not a deposit base. We're not a bank. We're not as closely regulated, for better or worse. So, you know, all of our facilities are bespoke. We try to respond to the practical realities of the environment that our originators are dealing in. We try to respond to, you know, things they're experiencing in their business real time. And so what does that mean? Well, it means, you know, we're having pretty frequent conversations about amendments and waivers to the credit documents, you know, where we can make introductions to other sources of capital, we'll do that. So again, I just think, you know, we want to be a constructive partner in this, and, you know, in all sense of the word, though we have recourse to the assets, we really are, you know, in the proverbial canoe together with our originators. You know, we focus on very early stage companies. So we don't want to be spending a lot of time, you know, frankly, foreclosing on assets and working out portfolios. We want to support our companies, so they're there to do that.
Great. And then switching gears back to interest rates, and maybe we can stick with you, Ed, for a minute. This interest rate environment, I think, is scratching a lot of people's heads. How has specifically that impacted your business? And, a little bit of advice for some of the originators here in the audience. How do you suggest companies kind of navigate the current interest rate environment?
Sure. Well, yeah, there's probably a lot to unpack there. I mean, I think, it's manifesting itself like kind of throughout the capital market. So obviously, we're on the debt side. To do an early stage equity deal now is virtually impossible. Only really the best companies are in market for fear of massive down rounds if they're even going to get a deal done. So you saw, third quarter numbers coincidentally were up, sort of across North American VC. I think valuations were up like 10%, but deal volume fell off a cliff between the third and the fourth quarter, and that's probably going to persist. So, we've seen it kind of on the other side of that, just like a massive amount of deal flow, folks looking to the capital markets, trying to shore up their funding in what is otherwise a very uncertain future. So, for us, I think, the guidance is to make sure, again, your funding relationships are stable. When you can, make sure you're capitalizing yourself well. The notion of being underlevered and overcapitalized is a good one. I mean, I think that, that is a true serum that a lot of founders can take. I think the pretense of growth that most VCs had invested in over the last few years doesn't exist anymore. Thinking through, so for us, we spend a lot of time thinking about unit level economics and, coming back, maybe finishing on, with a specific point as it relates to rates. Cost of funds have gone up, in some cases 300-500 basis points for most of our originators. That's not the spread. That's a function of the base rate. So we're not necessarily repricing risk. The market is. So what does it mean? It means if you're not earning, a healthy margin relative to your cost of funds, all of a sudden your business is not viable. And so for us, at the end of the day, that's what matters most. We want to make sure, in an environment where rates still have a little bit of room to run, that the assets can speak for themselves. And then you start thinking about kind of the credit story.
Jeff, some thoughts on the environment?
Yeah, it's been a tough year. I think it's, what folks have been constantly trying to keep up with the interest rate movement every month. And I know people reprice or have their rate cards or something like that. We obviously, as we fund real time, but they have to warehouse their deals. So we've definitely seen margins get compressed in deals where excess spread is meaningful to us and meaningful to them. That's obviously kind of shrunk. So, we're hoping, I think all the originators are hoping for a little more stable environment, because it was a bit of wait and see, because a lot of the competition, people just did not want to move their rates. So I think it's been a lot of catch up, because we haven't seen this kind of environment, like 2-year bonds or whatever, like the last time they were over 2.2 or 2.3% was 2008, 2009. So it's really that a psychological barrier almost that everyone's dealing with. So hopefully things level out and people can just get back to business.
With you, Neil, I know in past conversations with you, you're obviously very focused on profitability. Rates moved up very quickly. Affects your cost of funds. Have you been able, and specifically in your segment of small business lending, have you been able to pass on that to your customers? Do you find that that's been a challenge?
Yeah, I don't think there's a lot of room to pass it on in a challenging environment for small businesses. I think it makes you look internally and how you can be more productive with your team. I also believe that scale is important, right? And in an environment in which we're in, for us, we're focused on profitability, but we're also focused on merchant count, right? Adding to the team of merchants that we have in our book, making sure those merchants are sticky to our platform, and then selling them more product, right? So be productive internally in terms of your team. Make sure that you maximize the opportunity that you have with those merchants, and then keep them in the fold.
Great, thank you. Moving back over to Jeff, SLC has a wide variety of companies in its portfolio, different types of segments, and you get to see a lot, candidly, and I think everybody kind of is aware of that. You know, have you pivoted your focus towards certain segments of specialty lending? And if so, why? Is there some areas that you're more bullish on than others?
I would say we rarely pivot on any one sector. You know what? Many of the companies in our portfolio, there's some that have been around 20 plus years. There's some that are 2 years. So we would rather deal with the originators as they have a new idea or a new product or they need a tweak to the facility. We're always open. We look at our deals once a year or more with the folks that we deal with. So no, we typically don't pivot. We adapt, I would say. But absolutely, we're still looking for new asset classes because as things kind of mature and people grow up, we lose folks each year as they grow up in the world, maybe get bought, maybe get a new funding partnership. But we're also looking at new asset classes all the time. So hopefully we'll make some headway in the next a year or two there.
That's like the hard part of our business when your babies grow up and go on
I
to
know.
greener pastures.
Teenagers grow up and they leave the home for sure.
Friendly competition, I guess. But maybe, Ed, from your perspective, how have you pivoted, if at all?
Well,
between
I will tell you, you know, so I came in last night from New York City, and in spite of getting hit in the face with a blizzard this morning, we are pivoting hard into Canada, is my answer. No, so, you know.
Welcome to Canada.
Right. So I think, you know, credit quality has become paramount, right? And it's, I don't mean that in such a cliche way. So I think, one, because of the dislocation in the markets, we have, and by and large, it's driven by, I would say, just sort of an omnipresent concern about the stability of people's funding. So if it's banks, it's their deposit bases. If it's, you know, private originators, it could be their lenders. We have found ourselves more competitive on deals that we wouldn't have been in the past. So, you know, to give you a couple examples, like prime consumer would have been really hard at our cost of capital to do. Really short duration assets, you know, high quality hard assets like real estate. When you look at our portfolio, we do a chunk in real estate or prop tech. We do a chunk in classic fintechs, a small business and consumer. And then we do what we would call acquisition facilities, or, you know, supporting kind of aggregators of certain assets, mostly digital assets, consolidate their markets. So on balance, I think we're doing things that in the past we couldn't have been competitive on. So it's a little bit of a function of the market as much as it is us kind of sitting back and saying, hey, here's what we want our portfolio to look like kind of ex post for this environment. But it is giving us a chance to sort of diversify away from the concentration we have in our portfolio today.
So if the pundits are all correct, we're, you know, could be heading into a recession early next year. With that type of backdrop, are you, you know, being a little bit more conservative on new underwriting in particular areas at all?
Yeah, without question. I mean, for us, we want, you know, in the past we would, so one of the covenants that's typically in our credit agreements is a liquidity covenant at the parent level. Remember, well, maybe not remember, I didn't state this, but we finance at the asset level. So oftentimes we're financing an SPV that's off balance sheet, you know, to make a business a little bit more nimble. So though we will require, you know, liquidity and solvency at the parent level, in the past that was a 6-month liquidity covenant. So we would estimate whatever monthly burn is, multiply it by 6, and that generally is, you know, what the minimum cash requirement is. Today, 6 months is probably 12 months or 18 months. So that's a starting point. You know, I think we're more sensitive to the quality of shareholder support. So it doesn't necessarily mean brand name VCs, but it could, but it means people that are going to be there and have the financial wherewithal to support these companies, you know, again, for the next year or so until the fundraising market changes. And I think we are, you know, much more, I don't say rigorous, but much more sensitive to excess spread and unit economics. So in the past, you know, we'll model our deals to 2 or 3 times loss coverage. So what that sort of by and large means is things could get 2 to 3 times worse, whatever, you know, recessionary environment you are stressing your models with. You know, today 2 or 3 is probably 3 to 4. So we're generally like building a little bit more headroom into our deals, and by and large, you know, looking for better opportunities just because the market, I think, is affording us that ability to, given sort of the challenging funding environment.
Jeff, how have you tweaked?
If I could just build on
Yeah.
something that Ed said, again, I've been around for a while. In 2008, 2009, any of the companies that had difficulties in our portfolios got kind of stressed, kind of strained, but that wasn't the crux. It was light on the capital side. People struggled to cash flow. All their models were predicated on growth. I think you need to build a model that's not just predicated on growth. Growth is great, but not always. You can't do it at any cost. And quite frankly, that is where we had the most problem. It wasn't with the portfolios as much as the businesses themselves. So for anyone out here, I totally like what Neil has to say. It's a capital first for sure.
And I would say if you look at our portfolio, on the portfolio level, when you are in a recessionary environment, you say to yourself, how do you spread the risk, right? How do you reduce exposure to any one industry, to any one geography, to any one merchant, right? And because we have short duration loans, typically less than 12 months, I wouldn't say it's easy to do, but it's easier to do. And I think that if you've been through the 2008, 2009, if you've been through COVID, you kind of have an understanding of the landscape in that kind of environment. And frankly, we started taking that approach last June. And we kind of said to ourselves just after the MBO, and maybe that was a little bit of the impetus also, right? We had done our MBO, and we also saw a rising interest rate environment. So, you know, that's already 4 or 5 months ago. In a short duration asset business, you say to yourself, well, 4 or 5 months has already gone by. What does your portfolio look like today? And do a look back. And of course, our delinquencies are up in the last 90 days, but they're below historical averages. And I think that speaks to our credit team and how we have a broad distribution of merchants on all those levels in terms of geography, industry, and every other kind of distribution metric.
So, Neil, let's stick with you for a second here. Resiliency built through 2008, 2009, through COVID. You know, you're a small business lender, so obviously a lot of your borrowers would have been shut down during lockdown and the like. You conservative levered and cashed up. Certainly, you must have an interest in doing acquisitions at this point. Certainly, you must have an interest in growing the business. So tell me how you're thinking about that. How are you thinking about that in terms of whether it's product expansion or whether in terms of loan book growth? What is in the acquisition criteria of OnDeck today, and how are you going about it?
So, I mean, we know each other. You know, I'm pretty transparent in terms of our secret sauce. And again, I'll go back to our secret sauce is our people. But our strategic plan for 2023 really goes back to a reassessment during COVID and looking in the mirror and saying, what are we? And what we are fundamentally is a credit business, right? You know, you had a lot of people in our industry seeing COVID as a impetus to pivot, right? Pivot into a different kind of fintech, maybe a platform business, or, you know, and there were a whole bunch of concepts and ideas, and some work and some don't work, and, you know, for those that are able to pull it off, fantastic. But fundamentally, we started as a credit business, and we are a credit business. So our view going into 2023 is portfolio performance, 1. 2, scale, right? Both organically, and if there are opportunities, we'll pursue them as well. And then lastly, we're about supporting Canadian small businesses, right? We're about supporting them through COVID. We're about supporting them in good times and bad times. And we want them to be sticky to our platform. In other words, how do you ensure you're supporting them when times are tough? And then they're also not only buying our term loan, but they're buying our line of credit. So those are really the elements of how we view organic growth and maybe growth through acquisition. And scale, of course, in a small market like Canada is important.
Great. Maybe if we can switch back over to the funders on the stage. Ed, how have you seen M&A take place in your own portfolio? Are you finding a lot of your borrowers to pursue opportunities to scale up?
Yeah, so it's become another strategic option. I mean, M&A wasn't sort of a classic strategic avenue pursued by our portfolio companies, just given where they were. I mean, we're typically investing seed stage to Series B, so they're on the proverbial hockey stick growth trajectory. They have grand ambitions. They don't typically have, these are balance sheet intensive businesses. So most of the capital that they're raising are supporting their origination businesses. And then, obviously once they get to scale and create kind of more residual value from the assets, they can, do retained earnings and build equity value and consider M&A. That said, I think, this market obviously is presenting, if not opportunities, like imperatives for companies to think about it. So there's a part of our portfolio that is, more illiquid. They're portfolios of, again, small businesses or assets. They're inherently consolidation plays, and all of them are thinking about acquiring assets. I think, the fact of the matter is the market's littered with companies that probably shouldn't have gotten as much funding as they had, and that's gone. So, if you're an Amazon seller, an e-com business, and all of a sudden you can't finance your inventory, and by the way, there's been, if you look back over the last 12, 18 months even, there's like sort of the multiple whammy of supply chain issues, inflationary pressures, softening demand, right, and now rising rates. And so a lot of businesses that have, a warehouse full of stuff are stressed, and they need to figure out what to do with it if they can't continue to finance it. So a lot of our acquisition strategies are looking at kind of other portfolios to buy. Frankly, whether that's e-com business or even real estate, as I'm thinking through some of our prop tech portfolios. So they're getting offensive, I think, as a way to be defensive, if that makes any sense.
Karen G, what are you seeing in terms of the M&A market? And
Turning it back onto me.
We'll take your question and raise you a question.
I thought I was supposed to be asking the zingers. Well, actually, it's interesting. Your comment about overcapitalizing the industry and some folks maybe getting funding when they may not have at a particular time. We're finding that there is a number of companies that have had difficulty getting scale, and now they're thinking about, is there an opportunity to consolidate, partner, strategic collaboration in order to get that scale. It's difficult, but and you kind of spoke to it, that having that scale increases your operating leverage. So we're seeing opportunities, and we're pitching them because that's what bankers like to do. So, just in the time that we have left, and I see Tal ready to give me the hook, so I'll ask the last question. What is the one thing that the originators in the audience should keep in mind when they're thinking about growing their business in this environment? We had a lot of nuggets of knowledge that have kind of already been shared on the panel, but if you wanted to leave them with one thing, what would that be? And maybe we can start over with you, Ed.
Sure. So there was a lot of things bouncing around my head, but in the interest of time, I'll keep it simple. So Paul Graham from Y Combinator famously coined the phrase default alive. So make yourself default alive. What that means is, at your current trajectory with your current expense base, does the cash that you have on your balance sheet sustain you to profitability? If not, raise money.
Jeff?
I would probably say, because we get asked this a lot, is just build a good business. Build in the kind of institutional, I know it's boring, but think like an institution once in a while and know what they like, and stay open and honest with your funders, because to us, that's key in all of our relationships.
Neil?
just do what you say you're going to do, both internally and with your bank partners, with your vendors, with your team. And that'll instill the kind of confidence to propel your business into the future.
Well, I certainly agree with all of that. I would probably just say hire an advisor, Echelon Capital Markets. No, I'm just kidding. But this has been fantastic, gentlemen. Thank you so much for taking your time out of your day. I know it's a vote of confidence. The CLA appreciates it. I appreciate it. And good day to the rest of the conference. Thank you.
Thanks, Karen.
Thanks, everyone.